The garage was quiet except for the soft ticking of the cooling engine. Evan sat alone in a folding chair beside a shelf full of neatly labeled storage bins. Winter air slipped under the garage door in thin, invisible waves. On his phone screen, the banking app refreshed again. Another extra payment sent. Number 97. The remaining mortgage balance dropped by another few $1,000s, and for a moment, he felt the same thing he always felt. Relief. Not excitement. Not pride. Relief. Like something dangerous had briefly moved farther away from him. He leaned back and stared at the spreadsheet he'd been updating for almost 8 years. Every extra payment carefully tracked. Every principal reduction highlighted in green. Every month ahead of schedule circled like a small personal victory. And objectively, he was doing everything right. Stable income. Low expenses. No reckless spending. No car loans. No credit card debt. Just discipline. The kind of discipline financial people online love to celebrate. But then a strange thought entered his mind. A thought he immediately tried to push away. What if this feeling of financial safety was quietly making him poor? My name is Theo, and I spend way too much time thinking about the strange psychological relationship people have with certainty, debt, and long-term wealth. Because if you're someone who constantly feels the need to clean up your finances before you can finally relax, if you obsess over eliminating obligations because having debt in your life feels emotionally heavy, then this video might hit closer to home than you expect. And the strange part is this. Most people think they make financial decisions based on math. But they don't. They make them based on emotional relief. And the 15-year mortgage might be one of the clearest examples of that in modern finance. Because on paper, it sounds incredibly smart. Lower interest paid. Faster payoff. Guaranteed equity growth. More responsible. More disciplined. More adult. But over time, Evan slowly realized something uncomfortable. He wasn't building his financial life around wealth optimization. He was building it around the emotional need to eliminate uncertainty as quickly as possible. And those are not the same thing. When Evan bought his house at 32, he had two options: the 30-year mortgage or the 15-year mortgage. The loan officer explained both. The 30-year came with lower monthly payments and more flexibility. The 15-year came with a lower interest rate and a faster payoff timeline. But that wasn't what made the decision for him. What made the decision was emotional. The 15-year felt cleaner, safer, more controlled. Like the financially responsible version of himself would obviously choose it. And once he picked it, his entire life quietly reorganized itself around one goal. Kill the debt. Every bonus went into the mortgage. Every tax refund disappeared into principal payments. Raises increased mortgage contributions instead of investments. Vacations became smaller. Risk became uncomfortable. Liquidity slowly vanished. But none of this felt dangerous because psychologically paying down debt feels productive. You can see it. You can measure it. The balance falls every month. It creates visible progress. Humans love visible progress, especially anxious humans. Especially people who grew up associating debt with danger. And that's the part nobody really talks about. For many people, aggressive mortgage payoff is not actually a mathematical strategy. It's emotional regulation disguised as financial discipline. Because uncertainty creates psychological tension. And mortgage debt is one of the few financial problems that offers a perfectly measurable escape route. Just keep paying. Just keep reducing the balance. Just keep eliminating the threat. And every month feels emotionally cleaner than the last. Meanwhile, the invisible costs remain invisible. That's what makes this story complicated. Nothing about Evan's life looked financially irresponsible. In fact, everyone around him admired him. Friends called him disciplined. Co-workers called him smart. Family members said things like, "You'll be free so much earlier than everyone else." And technically, they were right. But wealth is not only about freedom from payments. It's also about freedom of options. And over the years, Evan quietly lost more optionality than he realized. At 35, a friend invited him into a small business opportunity. He couldn't do it. Too much cash locked in home equity. At 37, he wanted to take 6 months off after burnout. He couldn't do it. Too little liquidity. At 39, markets dropped sharply, and assets became temporarily cheap. But most of his excess capital had already disappeared into walls, flooring, roofing, and principal reduction. The money existed, technically, but inaccessible wealth behaves differently than liquid wealth. Home equity can make people feel rich while simultaneously keeping them financially rigid. And rigidity has a hidden cost, especially across decades. This is where the conversation becomes emotionally uncomfortable for smart people. Because the financially safe path often creates an illusion of optimization. But optimization toward what? That's the real question. Toward mathematical efficiency or emotional certainty? Because those two things frequently diverge. The strange thing about a fixed-rate mortgage is that time can quietly make the debt less meaningful. Inflation changes the emotional weight of fixed payments. A mortgage payment that feels enormous at 32 often feels surprisingly manageable at 45. Income changes, currency changes. Time changes the burden. But Evan never emotionally adapted to that reality. To him, debt still felt like danger. So even as inflation slowly reduced the real weight of the mortgage, he kept attacking it aggressively, as if eliminating it was the single most important financial objective in his life. And during those same years, something else was happening quietly in the background. Compounding, the invisible machine most people underestimate because it moves too slowly to create emotional excitement in the beginning. That's the cruel irony of long-term investing. In the early years, it feels unimpressive, while debt payoff feels immediate. Immediate certainty, immediate reduction, immediate psychological relief. Investing feels uncertain by comparison. The market fluctuates. Returns are invisible day to day. Nothing emotionally satisfying happens after a single contribution. And humans consistently overvalue immediate emotional relief compared to asymmetrical long-term upside. Especially intelligent humans. Especially disciplined humans. Because smart people are often even better at rationalizing emotionally driven decisions. Evan told himself he was maximizing wealth. But somewhere around year 11, he realized something painful. If he had taken the 30-year mortgage instead, and systematically invested the difference, his financial life might look completely different. Not because of one magical investment return, but because of time, liquidity, flexibility, optionality, and compounding. The difference wasn't small anymore. It had quietly become massive. Not overnight. That's what makes this psychologically difficult. The loss accumulated invisibly. A few $100s here, a few thousand there, years of missing market exposure. Years of reduced flexibility. Years of capital trapped inside a house growing at relatively modest rates compared to productive assets. And this is the moment where many people become defensive. Because mathematically weaker does not mean emotionally irrational. That distinction matters. There are absolutely people who benefit emotionally from paying off debt aggressively. Some people truly sleep better. Some people genuinely reduce destructive spending once obligations disappear. Some people need simplicity more than optimization. And that's valid. But the important thing is understanding what game you're actually playing. Because many people convince themselves they're making a wealth-maximizing decision when they're really making an anxiety reduction decision. Those are different objectives. And once Evan realized that, something shifted inside him. He stopped asking, how fast can I eliminate debt? And started asking, what system creates the strongest long-term life? That question changed everything. Because wealth is not only about net worth. It's about resilience, adaptability, optionality, the ability to absorb uncertainty without your entire financial structure collapsing emotionally. And ironically, his obsession with certainty had created fragility. Not visible fragility, psychological fragility. His entire financial identity depended on reducing obligations as quickly as possible, which meant uncertainty itself became emotionally threatening. That realization stayed with him for months, especially one night when he opened his mortgage app again and realized something strange. The lower the balance became, the more emotionally attached he became to finishing. Because humans are completion-driven creatures. Once we emotionally commit to eliminating something, we begin organizing our identity around the completion itself. And this is why smart people still choose mathematically weaker financial options all the time. Because certainty feels good, guaranteed outcomes feel psychologically clean. A paid-off house feels emotionally pure in a way index funds never will. No volatility, no headlines, no uncertainty, just ownership. And the human brain loves certainty so much that it often sacrifices asymmetrical upside without even noticing. Especially over long timelines where opportunity costs remain invisible. You never emotionally feel the investments you didn't make. You never emotionally experience the compounding that could have happened. You never see the parallel version of your life where liquidity created opportunities. So the brain focuses on what it can measure. Debt reduction. Balance, elimination. Completion. This is why behavioral finance matters more than spreadsheets. Because most financial decisions are not spreadsheet decisions. They're identity decisions, emotional decisions, lifestyle decisions. And eventually, Evan stopped treating debt elimination like a moral achievement. That was the real turning point. Because modern finance quietly teaches people that owing money is automatically bad. But fixed low-interest debt attached to appreciating assets behaves differently than destructive consumer debt. Used strategically, leverage can increase optionality rather than destroy it. But emotionally, many people cannot separate leverage from danger. So they spend decades trying to emotionally purify their balance sheet instead of designing resilient financial systems. That distinction matters enormously. Because systems survive inconsistency better than motivation does. Automation matters more than emotional intensity. Behavioral structure matters more than occasional discipline spikes. And long-term wealth often comes less from heroic sacrifice and more from sustainable allocation systems repeated for decades. That realization made Evan rethink almost everything. Not because he suddenly became reckless. Not because debt became good. But because he finally understood something subtle. The goal was never to eliminate every possible uncertainty from life. The goal was to build a system capable of surviving uncertainty without emotional panic. That's different. Very different. And strangely, once he stopped obsessing over rapid mortgage elimination, he actually felt calmer financially. Because his entire future stopped depending on one giant emotional finish line. Instead, he built automated investing systems. Maintained liquidity. Allowed fixed debt to exist without treating it like an emergency. And most importantly, he stopped confusing emotional relief with financial optimization. Years later, he sat in that same garage again, older now. The spreadsheet still existed. But he barely opened it anymore. Because he finally understood something that had taken him almost 15 years to realize. A financial decision can feel responsible, while quietly reducing future freedom. A financial strategy can reduce anxiety, while simultaneously reducing long-term optionality. And sometimes the biggest financial mistake intelligent people make is assuming the emotionally comforting decision must also be the mathematically superior one. But life rarely works that cleanly. Sometimes certainty costs more than uncertainty. Sometimes liquidity matters more than ownership speed. Sometimes flexibility outperforms completion. And sometimes the financial decisions that feel the safest quietly cost the most future wealth. Thank you so much for watching this video, and don't forget to subscribe to see the latest videos. I wish you success.